Your alarm blares at 6 a.m. You rush out the door to sit in traffic on your way to a job that barely moves the savings needle. And you wonder if the phrase financial freedom is just an Instagram hashtag. Meanwhile, a quiet group of doctors, dentists, and engineers are collecting quarterly checks from apartment buildings they've never even seen. What do they know that you don't? Stick around because in the next few minutes, I'm breaking down the exact playbook they're using and how you can plug into it without swinging a hammer or screening a single tenant. It's a game changer, and it's probably not what you think. So get ready because we're about to jump in. But before we get started, make sure to subscribe and hit that like button. Most of us hit the same 3 bricks in the wall, don't we? Number 1, we trade our time for money, and there's only so much time in a day, let alone a lifetime. It's a finite resource, and burning it for a paycheck feels like a constant uphill battle. Number 2, we don't have a spare million laying around to buy a 200-unit complex ourselves. That kind of capital feels light years away from most working professionals. And number 3, we're allergic to midnight calls about broken toilets, leaky roofs, or tenant disputes. And let's be honest, who isn't? Traditional real estate gurus scream, house hack a duplex. But you still end up painting walls at turnover and dealing with messy evictions. Not to mention sacrificing your own personal space. The wealthy, they skip the small stuff and go straight to scale. Because scale is where the real tax breaks, loan leverage, and consistent cash flow kick in. The problem is that kind of scale feels utterly impossible for most people. So we stay stuck behind the invisible wall, grinding, scrolling, and just hoping for a different outcome. It's time to smash that wall. Picture an airliner. The pilots up front navigate, talk to air traffic control, and keep the engines humming along, ensuring a smooth journey. Passengers, on the other hand, simply buy a ticket, sit back, enjoy the ride, and wake up in paradise. Apartment syndication works the exact same way. General partners, or GPs, are your pilots. They're the experts who underwrite deals, secure financing, oversee renovations, and manage the property day to day. They do all the heavy lifting. Limited partners, or LPs, are the passengers. You put in capital, often a $25,000 or $50,000 minimum, and collect distributions while you sleep, literally. The plane leaves without you stressing liftoff angles. The pilots get paid when everyone lands safely and profitably. That clear separation of labor is precisely why busy orthodontists, software engineers, and even small business owners absolutely love this model. It's mailbox money without any of those dreaded tenant headaches. It is truly passive. So why do the rich keep parking their hard-earned dollars in these deals year after year? It's not magic. It's because of 4 powerful levers that work together to multiply wealth. Number 1 is cash flow. Renters pay monthly, and those profits hit your account quarterly. This is your immediate return, providing a steady stream of income. Typical preferred returns often start at a solid 6 or 8%, meaning you get paid first before the GPs take their share. It's consistent, predictable income. Number 2, appreciation. Syndicators are experts at forcing value. They do this by renovating outdated units, driving up rents, and boosting the entire building's worth, sometimes by millions. When the property sells in year 5, for example, the proceeds are split, usually 70-30 or 80-20, in favor of the limited partners, often doubling your initial equity. It's like buying a diamond in the rough and polishing it to brilliance. Number 3, tax shelters. This is where it gets really smart. Depreciation and cost segregation studies create significant paper losses that can effectively wipe out quarterly cash flow on your K1, sometimes even offsetting other passive income. This means you keep more of what you collect, legally reducing your tax burden. It's a powerful advantage most traditional investments just can't touch. Number 4, amortization. Every month, as tenants pay their rent, a portion of that money goes towards paying down the mortgage. This quietly and steadily grows your ownership slice in the property risk-free. You're building equity without lifting a finger. Stack those four levers together, and a $100,000 position can realistically turn into $220,000 in half a decade, legally tax deferred. We're talking Warren Buffett level returns here, but without the Buffett level work or the need to be a market genius. It's truly remarkable. You might be thinking, but I'm not rich. Relax. You don't need to be lighting cigars with hundreds or owning a private jet to get started. You need a few key things. Number one, to meet SEC guidelines. That means being either accredited with a $1 million net worth, excluding your primary residence, or $200,000 in income for an individual or $300,000 for a couple, consistently for the last 2 years. Or sophisticated, meaning you can demonstrate knowledge and experience in financial matters, even without the income and net worth requirements. Many deals thoughtfully allow for either pathway. Number two, capital you won't panic spend next month. This is not an emergency fund. Think about where you might find this: IRA rollovers, equity from a home refi, or bonus cash that's just sitting there. And number three, a willingness to read a 75-page private placement memorandum without glazing over. It's the legal blueprint, and understanding it is key. If you can honestly check these boxes, congratulations, you're boarding pass eligible. If you're not accredited yet, don't despair. You could partner on a 506B syndicate that legally accepts up to 35 non-accredited but sophisticated investors. There's a path for you too. Remember, bad pilots crash metal, bad sponsors crater cash. Seriously, vetting your GP is the most crucial step. Here's your non-negotiable checklist. Track record. Ask to see minimum 2 to 3 full cycle deals in the same asset class. Don't just look at pretty projections. Ask for the actual internal rate of return, or IRR, on their exited properties. That's real, realized returns, not just hopeful estimates. Skin in the game. Look for sponsors who invest 5 to 10% of the total equity from their own pocket. No one wants a pilot parachuting before the passengers. This shows genuine alignment of interest. Conservative underwriting. Are they assuming 4% rent growth in a flat market? That's a massive red flag. Just pass and move on. Look for realistic, even slightly pessimistic projections on rents, expenses, and occupancy. They should clearly outline their downside protection. Transparency. Do they provide monthly dashboards, host quarterly Zoom calls for investors, and offer audited financials? Open communication and clear reporting are non-negotiable for true partnership. References. Talk to 3 current limited partners. Ask specific questions. How responsive is the sponsor? Are their reports clear? Have they met expectations? If they hesitate or give vague answers, you should definitely hesitate too. And just to be safe, always Google the sponsor's name plus terms like lawsuit and SEC violation. Trust but verify, and then verify again with a magnifying glass. Your capital and your financial future deserves that diligence. Ready to get started? Here's your practical 5-step on-ramp to becoming a savvy passive investor. Number 1, budget. Decide how much capital you can comfortably lock up for 5 to 7 years. This is long-term money. Don't invest what you might need tomorrow. Number 2, educate. Read 2 essential books: The Best Ever Syndication book by Joe Fairless and The Hands-Off Investor, An Investor's Guide to Passive Real Estate Syndications by Brian Burke. Knowledge is power here. And number 3, subscribe to deal flow lists. Sign up directly for reputable sponsor websites. This is how you'll find opportunities. Get familiar seeing how these opportunities are presented. Review the assumptions and learn the terminology. 4, interview the sponsors. Set up meetings with the sponsors. Ask them about their track record. Ask them how much they contribute to each investment. And number 5, fund. Wire the money, then turn your attention back to your family, your passions, and your day job. Let the pilots fly the plane. Your work is done, at least until the next distribution. All right, so let's be real. Markets cool, pipes burst, and occupancies dip. Your capital is illiquid. until a refinance or a sale, sometimes for several years. Sponsor incompetence or unforeseen market shifts can equal delayed or reduced returns. This is not a risk-free lottery ticket. Mitigate these realities by diversifying across different markets and with multiple operators. Don't put all your eggs in one basket and with one pilot. Avoiding deals with short-term bridge debt. Unless there's an exceptionally clear, rock-solid refinance plan in place, this can be a high-risk strategy and one I would avoid. Keeping a 6-month personal emergency fund fully stocked, so you are not the limited partner begging for an early redemption. Real estate is about higher returns, yes, but it's absolutely not risk-free. Respect gravity and invest responsibly. If this is clicking for you and you're seeing the possibilities, go ahead and download the Busy Professional's Guide to Hassle-Free Wealth using the link in the description below. It includes everything you need to know to invest with confidence in apartment syndications. Now let's paint a hypothetical picture. Imagine you invest $50,000 into a 150-unit complex, bought at $60,000 per door with 85% occupancy and $950 average rents. The business plan includes investing $7,000 per unit on interior renovations, aiming to raise rents to $11.25. We're looking at a 5-year hold period. Year 1 cash flow. With a 6% preferred return, that's $3,000 flowing directly to you. Not bad for doing nothing but investing. Now, sale in year 5. Assuming an exit cap rate of 5.3%, the price effectively doubles your original equity. Your share of the net proceeds could be approximately $70,000 after the return of your original $50,000. So let's tally it up. Your original $50,000 back, plus $70,000 in sale proceeds, plus $15,000 in cumulative cash flow over 5 years. That's a grand total of $135,000 on your initial $50,000 investment. That translates to a 2.7 equity multiple, roughly 22% annualized returns. Now compare that to your 401k, quietly handing you 8% in a year, and you'll instantly see why dentists, doctors, and engineers have a Kool-Aid smile on distribution day. These aren't just numbers, they're life-changing returns. Financial independence isn't some mythical beast. It happens when your passive income consistently covers all of your living expenses. Say you need $8,000 a month to live comfortably, to truly live well without needing a job. At a conservative 7% cash-on-cash return, that would require roughly $1.4 million invested. Sounds huge, right? But you're not dumping it all in one scoop. You stack deals, brick by brick. Year 1, your first $50,000 investment starts generating about $3,000 a year. A great start. Year 2, you make another $50,000 investment, maybe reinvest some early proceeds, pushing your annual income to around, say, $7,000 per year. Year 3, you roll over some capital from a 401k or another investment, adding $200,000, now generating about $21,000 a year. By year 6 or 7, between compounding, cash flow, appreciation, and refi exits, you could be near $96,000 annually. That's your $8,000 a month, all without any landlord drama. Each deal is a Lego brick. You build that financial tower brick by brick until the day job becomes not just optional, but a distant memory. It's a journey, not a sprint, but the destination is truly liberating. All right, this is where the real ninja moves come in, helping you keep more of what you earn. Hold your syndication shares inside of a self-directed solo 401k. All those returns flow back tax-sheltered, allowing your money to grow even faster. Or park them in a Roth self-directed IRA, and at sale, 5-figure gains can come out entirely tax-free at $59.5. Imagine that. Another incredibly powerful hack. Passive losses from one syndication, especially those with heavy depreciation, can legally offset passive gains from another. You could strategically pair a strong cash flow deal with a heavy depreciation ground-up development, effectively zeroing out taxable income across your entire real estate portfolio. And no, this isn't skirting the rules, it's using them intelligently. Loop in a syndication-savvy CPA, and their expertise will save you multiples of their fees in taxes. Seriously, don't skip this step. All right, time for a quick Q&A. Can I 1031 into a syndication? Not directly, but you can definitely 1031 into a tenant in common interest first, which can then be syndicated. It's a two-step process. What happens if recession hits? Sure, rents may dip 5 to 10%, but diversified Sunbelt markets with fixed-rate debt have historically proven resilient, staying above break-even. Multifamily is often the last shoe to drop and the first one to rebound because people always need housing. What's the minimum to start investing? Most large sponsors open at $100,000 or higher, but I keep my minimums at $50,000 to make these investments more accessible to working professionals. If you've got more questions, drop them in the comments below. I try to answer every single one within 24 hours. Ready to swap some earned income for that sweet mailbox money? Grab the free Busy Professionals Guide to Hassle-Free Wealth linked in the description. It includes everything you need to know to help you invest confidently in apartment syndication. Click it, download it, and start building the freedom you keep saying you'll chase someday. Someday is spelled T-O-D-A-Y. Let's make it happen. You can spend the next 5 years grinding it out for 3% annual raises, watching your savings crawl along while losing ground to inflation. Or you can buy seats on someone else's airplane. Let the professionals do the work and have tenants send you checks every single quarter. Apartment syndication isn't a magic bean or a get-rich-quick scheme. It's a proven, albeit boring, numbers-driven path the affluent have used for decades to sidestep the landlord grind and build serious wealth. Educate yourself, vet those pilots meticulously, and take that first small, courageous step. Wire one subscription level payment into a quality deal. Watch that K1 hit your mailbox, and I promise you, you'll never look at a 9-to-5 the same way again. If you got any value out of this video, do me a favor and like, subscribe, and hit that little notification bell so you don't miss the next one. Make sure you review the free guide, and I'll see you on the next flight to genuine financial independence. And as always, I'll see you in the next one.